If you're self-employed and you're frustrated when it comes to using tax returns to get a traditional mortgage, then you really have three paths you can choose: a bank statement loan, a 1099 loan, or no ratio loan. So in this video, I'm going to go over why you're having trouble probably getting a mortgage using your tax returns, and talk about each one of those kinds of loans and when they might make the most sense. So let's first talk about why you're getting frustrated when maybe you've been talking to a lender or a bank and they are not approving you for the amount of a mortgage that you think you should get approved for and want to get approved for. So the most common misconception I have when I talk to self-employed borrowers is that money that comes in as far as sales is not money that is treated as income to qualify for a mortgage. So in general, and very simply, your income as far as mortgage qualification goes is the amount of money that you paid taxes on. So, simple example, let's say that you have top line sales on your tax return of $500,000. Then you have expenses. Let's say you've got rent on your, rent for your business. You have advertising, you have supplies, whatever, on and on and on. And it's very common that I'll see people paying tax on $500,000 in sales. Maybe they're really only claiming, say, 80. Or for easy math, we'll say $100,000 is what they're paying tax on. So that's your income. And then a lot of times, self-employed people, if you're watching this, you probably know, you might have more liabilities on your personal tax return because you're carrying expenses for the business. You know, business credit cards, lines of credit, who knows what. And so then there's just not nearly enough income to qualify for the mortgage that you want. So when this happens, we have these three other choices that we can choose. And I'll also say, what I always do is look at the tax returns, because just because you've been talking to a bank or a lender doesn't mean that they knew what they were doing or weren't able to think outside the box. So I specialize in working with self-employed clients. I've been doing this for 20 plus years. And as a mortgage broker, there are many different paths we can take. And some lenders that maybe you might talk to have what they call lender overlays. That means just because Fannie Mae or Freddie Mac will do it, doesn't mean they'll necessarily do it. So I always look at the tax returns, and there are definitely times where I find, you know what, if we move some things around and really think outside the box, we can make this work as a normal mortgage. So if you reach out to me, go to my website, mortgagesbyscott.com. You can fill in a little form and send me an email basically and tell me your story. And I would love to help you see if that works. Let's say that doesn't work. So then the next thing we would look at is a bank statement loan. So bank statement loan is where we don't use tax returns at all. The lender doesn't want to see the tax returns. What they will look at is your last 12 months of business bank statements. And in general, what they're going to do is add up all the deposits. Now, these can't be transfers from another account. It has to be true deposits. Now, those can be, Venmo sales or credit card deposits or whatever. They just have to be real sales. Anyway, add up all those deposits. And then depending on the nature of your business, we're going to use at least 50% of the deposits and treat that as your annual income. Now, if you're a type of business, let's say you're a consultant, for example, you work from home, you don't really have any overhead. They might use 80% of your deposits and treat that as your income. What I generally find is that the income is not a problem when we use bank statements instead of tax returns. What I typically see is maybe down payment. So the minimum down payment is 10% across the board. So you have to have at least 10% down. And of course, the less you have down, the higher the interest rate. Now, also, higher your credit score, the lower the interest rate. So that usually balances out. But also you have to have some reserves. So reserves are just very simply number of months of mortgage payments that you have in some sort of account after closing. That could be a bank account, savings account, could be a retirement account. But anyway, you just have to show that you have the ability to make some mortgage payments. It's typically going to be 3 to 6 months. So another type of bank statement loan is, let's say, now sometimes it might be that you don't have quite enough deposits into the business account, but you tend to transfer all of your, or lots of your deposits in your business account right over into your personal account. Well, in that case, if you have a business account and a personal account, then we can use the last 12 months of your personal bank statements and use 100% of those deposits. So there's a number of different ways to make that work. In general, that usually works best unless we come to the next one, a 1099 loan. 1099 loan works exactly the same way, except it's much simpler. If you tend to get all of your income through 1099s, then we would just use whatever you got. If you got one 1099 or 10 1099s, it doesn't matter. We add them all up and we use 90% of the 1099, and that's your income. Now, we can also combine that with a W-2 worker. Let's say you're married, your spouse has a W-2 job. We can use your 1099, their W-2, and combine them and make something work that way. But again, it's a minimum 10% down payment. The interest rates and everything, the reserves work exactly the same way. Well, let's say that neither one of those work. Let's say that your business is too new. Maybe you haven't even started your business. Maybe you've been in business less than 1 year. Then we would use what's called a no ratio loan. Now, this is what a lot of times I think of as the loan of last resort. It's not really, but a lot of times I also do this as a cash out refinance. The way it works is, as long as you have 20% down payment and you have at least a 680 credit score, for 20% down, it's actually going to be over a 700 credit score. If you have a 680, then you have to put 25% down. That's it. You don't list any income on the application. And you would have to have 6 to 12 months of mortgage payments in reserve. In other words, in some sort of account after closing. So what's the caveat to that? It's going to be a higher interest rate. It's an expensive loan. So they're going to charge at least 1%, probably 2%, and it's going to have about a 9% interest rate. So it's not great, but sometimes it's just a short-term loan. So maybe you have it for a year or until you get in a position where you can get either a bank statement loan or use a traditional tax returns and get a loan that way. I'm actually refinancing a client right now who we started with a bank statement loan at a very high interest rate for whatever reasons. Then we refinanced it when his credit score got quite a bit better. We refinanced it to another bank statement loan, really lowered the interest rate. But now things have totally straightened out. We're just using his regular tax returns and we're getting him a traditional jumbo mortgage with a great interest rate. So really those are the three main different ways. There are some other types of loans. Like if you have a lot of money, we can basically just qualify you on the money. It doesn't have to be a job or anything. Or there's a profit and loss type of loan. But we can get into that in another video. So if you found this video helpful, it'd be really helpful for me if you hit like and subscribe, share it with somebody you know that's self-employed, and if you have any questions or comments, put them in the comment section, or just go to my website, mortgagesbyscott.com. You can send me a note through the website, tell me what's going on with your situation. We can get on the phone and then, have you do an application and figure it out. So thanks for watching.